Hello and welcome to another exciting episode. I'm your host Kushal Lodha, founder of KAGR, an education company in financial literacy.
So Kushal, futures trading. It sounds complex but also fascinating. How would you break it down for someone who's new to this concept?
Futures trading is basically an agreement to buy or sell an asset at a future date for a price decided today. It's a type of derivative, meaning its value comes from an underlying assets like stocks, commodities or even currencies. For example, अगर आपको लगता है कि किसी commodity की price 3 महीने में बढ़ने वाली है, for instance gold, you can enter into a futures contract to buy gold 3 months from now at a price fixed today.
Oh, interesting. So what exactly is in a futures contract?
Great question. A futures contract specifies the quantity of the asset, the price at which it will be bought or sold, and the delivery date. Let's say an oil futures contract might specify the delivery of 1000 barrels of oil at rupees 5000 per barrel 3 months from now. The unique thing is both parties have to stick to the terms of the contract at the specified date, unlike options जहां buyer को right होता है but not the obligation to execute the contract.
Right. What is the essential difference between futures and options?
Futures contracts are standardized and traded on exchanges, making them transparent and regulated. Unlike options, where the buyer has a choice, futures contracts are obligations. For instance, अगर आप एक इंडेक्स का कॉल ऑप्शन खरीदते हो for 17,000 strike price, you can choose not to exercise the option if Nifty is below 17,000 on the expiry date. Futures, on the other hand, bind both parties to the agreement.
Do market conditions determine future prices?
Market conditions are crucial. If the market is bullish, futures prices for assets like stocks or commodities might be higher than their current spot prices. Conversely, in a bearish market, futures prices might be lower. For example, during the 2008 financial crisis, crude oil futures prices dropped from around $145 per barrel to just over $30 per barrel, showing fears of a global recession.
That's a big drop. I want to know more. How about a real-life example closer to home?
Sure, imagine a farmer growing wheat in India. He can use futures contracts to lock in a price for his crop, protecting against the risk of falling prices at harvest time. Let's say if wheat is currently priced at rupees 2000 per quintal and the farmer expects the price to drop, he can enter a futures contract to sell wheat at rupees 2000 per quintal in 3 months. This way, he ensures he receives the agreed price regardless of market fluctuations.
That's a smart move. But I have heard many retail traders struggle with futures trading here. Any insights on that?
Derivatives such as futures and options are mainly for the purpose of hedging. They can be risky if they are used for the purpose of speculation. Studies show that around 90% of retail traders in India lose money in futures and options trading. For example, in financial year 2022, the average loss per trader was close to 50,000 rupees. The high leverage in futures trading amplifies both gains as well as losses. एक छोटा सा adverse movement in the underlying asset can wipe out a trader's entire margin.
Can you give us a hypothetical example to illustrate this?
Sure. Let's say you decide to trade Nifty futures. Let's assume that the current Nifty index is at 15,000. You think it will go up, so you enter a futures contract. The contract size is 75 units of the Nifty index and the margin requirement is 10%. So you need to put up 1,12,500 rupees, which is 15,000 into 75 into 10%.
So you are controlling a position worth 11,25,000 with just 1,12,500.
Exactly. Now, if the Nifty goes up to 15,500, you make a profit. Your profit would be 15,500 minus 15,000 multiplied by 75, which is 37,500 rupees. That's a 33.3% return on your margin. But if the Nifty drops to 14,500, you lose the same amount, which is 37,500 rupees, which is a 33.3% loss on your margin. अगर Nifty सिर्फ 7% नीचे चले जाए, the trader loses their entire margin. That's why leverage is risky, especially for retail traders who might not have the deep pockets or risk management strategies to handle such volatility.
Explain us about some of the proposed regulations of SEBI regarding options trading.
SEBI has increased the minimum contract size for equity derivatives to rupees 5 lakh to ensure that only serious investors participate. The Working Committee of SEBI on Futures and Options has recommended increasing the minimum lot size of derivative contracts to rupees 20 lakh to 30 lakh rupees from rupees 5 lakh presently, and even restricting weekly options to only one expiry per stock exchange per week. They have implemented peak margin rules with the intent to limit excessive speculation. SEBI has also mandated brokers to disclose the percentage of profitable clients in derivatives trading, promoting transparency and helping retail investors make informed decisions.
And the recent changes in the Securities Transaction Tax, STT, how does that fit in?
Sure, the Union Budget for 2024-2025 increased the STT on futures from 0.0125% to 0.02% of the contract value. For example, अगर एक ट्रेडर निफ्टी फ्यूचर सेल करता है at rupees 24,500, the STT rises from rupees 77 to rupees 123 per contract.
Given these challenges, what is being done to educate retail investors?
Both regulators and exchanges have launched educational initiatives. NSE and BSE have programs to educate retail investors about the risks and complexities of futures trading.
Looking ahead, what trends do you see shaping the future of futures trading in India?
Several trends will shape the future. Regulatory efforts will likely focus on enhancing financial literacy and possibly introducing stricter eligibility criteria for retail traders.
That's a lot to consider. Thank you, Kushal, for breaking down the complexities of futures trading for us.
My pleasure. Futures trading is a powerful tool, but it is essential to approach it with knowledge, understanding, and caution.
Absolutely. Thank you to our listeners for tuning into this podcast. Stay informed, stay invested, and we'll see you in the next episode.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.